Welcome to the PlanStrongerTV market update for Wednesday, July 15th, halfway through the year, halfway through the month. Let's take a quick look at the numbers. Of course, we always start with looking at the prior year total return, and you can see the numbers for the indices that we track and comment on with our update. And then we'll slide over and take a look at the year-to-date numbers, just over, of course, 6 months, 6.5 months. And you see continued strong performance. Again, day-to-day market activity, up, down, we're going to see that. That's always going to be the case. I think we get suspicious when it's not. But you'll see strong performance across the board. Obviously, big standout is small caps, still continuing their strong surge year-to-date, almost double of what we did last year. And again, these are raw year-to-date numbers, not annualized. So a strong showing for the market. Bonds flat, and then I will give the balance of my time to Robert here. Robert, so let's talk about where we are with some of the numbers that are supporting this strong performance for the market. Because the stock market, doesn't just say, oh, well, we think things are going to be good. There's data, there's information that they look at. So where are this sense of enthusiasm for market participants coming from, and do we have some new data that's come out?
Yes. So the main reason for those green numbers, the small caps, mid caps, non-US, NASDAQ, S&P 500 earnings have been exceptionally well for companies. And that was despite the Iran conflict and the fear of inflation spiking, et cetera. So that's kind of where these numbers are coming from, earnings. Number two, the second part of your question, David, any new data that came out yesterday and hot off the press this morning, we'll hit both. Yesterday, a beautiful, fantastic inflation number, CPI numbers. So that should, not necessarily, there's always other metrics to be involved, but should add fuel to stock prices. But yesterday, inflation numbers, I'm going to try to not go in all the numbers, but basically month over month fell 0.4%, and the expectation was for a drop of 0.1. Last month, it was an increase of 0.5%. So annual, and that's the best reading, or the largest drop, I should say, the largest drop since the spring of 2020, more than 6 years ago, David.
For inflation.
For the CPI, month over month drop, yes. Year over year, in May, we stood at 4.2%. The expectation was to drop to 3.8. We hit 3.5. So yesterday, fantastic numbers for that. This morning, same thing with PPI, the producer price index. Year over year, it's interesting. We were at this level, and everybody expected, or the analysts expected, higher numbers for both headline and core. Core strips out the volatile food and energy components. In fact, not only did the numbers not increase, David, but they actually came in lower for both categories.
Which is good.
Which is very good. So CPI yesterday, PPI today. But one thing I want to add about the CPI numbers yesterday, the viewers might be thinking, okay, oil, gas prices came down, fine, but strip that out. I bet everything else went up. No, so the data is actually better than the very good headline suggests. Just for services less rent of shelter fell 0.2%. Core goods prices down 0.1%. So it wasn't only the reduction of gas and oil prices, but we're seeing the reduction in prices and price pressures across a lot of data points, and that's very good news.
And that makes sense because, oil and energy is in everything, and so that makes sense. And a couple of other things, that I want to kind of draw a line under is, and this is, I think, a question that a lot of the viewers would have, Robert. We hear about economists making predictions, and it's almost, I don't know, I can't think of the right word. It's just almost like counterintuitive that they always seem to be wrong. Okay, we see the market doing what it's doing, and again, the market can change any time. Something could happen. So we're not telling you, hey, step on the gas. market's going to do great. It's going to always be hunky-dory. There will be downturns, pullbacks, corrections. We've talked about what can happen, bear market. But the interesting thing to me is I have watched this for 3 decades is the economists react to whatever expectation they have, and they talk a lot, and then the data is going to be what it's going to be, and we don't know what it is until it actually gets reported. So what we're seeing is, and my takeaway from what Robert shared is you have the market doing well because of real earnings, right, Robert? I mean, we've got earnings that are supporting the market. So it's not just that the market is saying we think interest rates are going to stay the same or go down, and that inflation is going to be tame. The market is already priced to reflect the strong earnings growth you mentioned. Then on top of that, we're seeing, as Robert said, some additional fuel for the fire. Now, we'll see how that plays out. But if you've got a longer period toward using your money, there's no reason, that you can't have some equity exposure. We're definitely not saying let's run for the hills and cash in and sit on a bunch of cash.
Right. And an interesting thing about the inflation reports is with the resumption of hostilities in the Persian Gulf, Strait of Hormuz, et cetera, the CME FedWatch tool, which predicts if the Fed's going to raise rates or what the probability is of either a rate hike or rate cut, it was 25% for a rate hike, 0.25% or a quarter of a percentage point in exactly 2 weeks from today, July 29th. It got up a few days ago, it got up to 35% chance of a hike. After yesterday's inflation data, down below a 17% chance. So we went from 35% chance of a hike to less than 17% chance. So that new data coming in is the prognosticators who play the markets and the betting markets are saying, you know what, most likely not a rate hike.
I would say nothing. They're not going to do anything because, if there's not a reason to lower rates. It's a question of whether there's a bias toward lowering rates, staying pat, or raising them. And I don't see a bias toward raising. Maybe stay flat and have kind of like an inertia where they don't move unless they really have to. Although, there is a mood of, and this has certainly been signaled by the administration and the president wanting to lower rates for Americans and for, stimulating growth. But the Federal Reserve also always keeps in the back of its mind, we're going to maybe hold off. If we don't need to lower rates, we're not going to if the economy is doing well, if we're seeing this data that Robert's talking about. Because you know what? We want to have the ability to lower rates if something happens that does affect the economy. We have some sort of shock in the system that we can drop rates, quarter, half, full point and really stimulate things.
Right. Yep.
So they like to keep a little bit in reserve. So, all right, well, we'll continue to monitor this. I think it's very interesting how some of this is playing out. And, you made the comment about Iran and that ongoing conflict, Robert. It seems as though there's been this continued effort to negotiate, memo of understanding. But from my vantage point, what I see is a kind of a reduction or a lack of emphasis on, okay, we're going to negotiate this deal. And now it just seems like, all right, fine, we're going to just eliminate you as a threat. We're going to take care of being able to get through this strait. And I'm just not seeing a reconciliation that is anything short of just complete surrender.
Well, in terms of just what's going on, what I see is the strait was closed for a period of time, one and a half months ago, but now Iran's capability or ability to close that has waned significantly. Yeah. Regardless of the conflict, just as long as ships, oil, natural gas, cargo, merchandise can pass through. I think shippers are getting more comfortable with the U.S. presence. And even though the resumption of hostilities has continued, we are still seeing movement through the Strait of Hormuz. That's what's going to keep prices down. And one, I have to throw this out there. This is just a tangent that I think our viewers would like to know. NFIB, the National Federation of Independent Business, they came out with a small business optimism index. It went up from a reading of 95.3 to 97.4, very close to its 52-year, not 52-week, 52-year average of 98. So small business optimism was kind of depressed. That sprang up significantly as well. That data came out yesterday as well. So, a lot of data points pointing to increased optimism, less inflation. Let's move forward.
Good. Well, we're a small business, okay? we're more optimistic today than we were, a year, 5 years, 10 years ago. So, and I think one more comment, because we haven't had a chance to talk about this in a little bit. One more comment, Robert, as it relates to energy. While we've been seeing the headlines and even for those of us that dig into more detail and data, there's been a lot going on that we don't hear about. And so, for example, energy suppliers, countries in partnership with the United States and in partnership with others, working on ways to get fuel, natural gas, oil to where it needs to go without having to go through this Strait of Hormuz, or Hormuz, but with a Z, having to go through that strait and working around a lot of workarounds that have been in place. So the ability for that to be a choke point and a pressure on energy price and a instigator of market volatility is being, I think, tamped down in a lot of ways. So let me put it this way. There's only so much room in the headlines, right?
Yes.
So there's only so much that can go into the headline news or what we hear and see. And there's a lot going on, I think, below the surface, no pun intended.
Absolutely.
All right, well, that's enough for today. But you can tell we will be continuing to monitor and bring good information, things that you can at least think about. Maybe you take specific actions, maybe you don't, but we'll help you continue to plan stronger.